Welcome to July 1st, everybody. Scott Riley, the Market Update Desk with Mortgage One, NMLS 157524. We are reveling in the hot weather that we're having. I hate cold weather at all costs. So, this hot weather, I've got windows open, loving it out in the Cabana office, usually in the afternoon working. So, we're just loving the temperatures here. Today, we'll go over a couple things here. We had a very negative end of the day yesterday. We reversed course very quickly and very hard. The reason being, Cleveland Fed President Beth Hammack stoked inflation fears yesterday with some very interesting, odd, and bizarre comments on why she feels the Fed should hike rates and why inflation will rise. She specifically indicated that higher oil prices caused inflation to rise. Yes, that absolutely makes sense. But then she also feels lower oil prices will continue to cause inflation. Yep, that's what she said. Lower oil, higher inflation. The reason being, she believes the drop in oil prices will cause consumers to have more discretionary income, which will cause prices to rise. She also said that AI will cause more inflation. Now, that's despite the fact that most others, like Fed Chair Warsh, believe that AI will be deflationary because of the increase in productivity that it brings to the table. In fact, we're already seeing AI cause job cuts. The Challenger report showed that AI was the top specific reason for job cuts in the fourth month in a row in June. Accounting for 31% of the total cuts was AI related. Year to date, it's accounted for nearly 1/4 of all job cuts. So we strongly disagree with Fed member Hammack. She's a voting member, and the bond market reacted very negatively yesterday and is following through, even this morning. Now, we believe she's clearly showing that she is far end of the hawk realm on the board and wants to see rate hikes. Very interesting. Now, when oil was lower pre-war, she didn't make comments that low oil prices would be inflationary and cause more people to have discretionary income, which would increase demand on items and then therefore higher prices. Very odd comments and definitely out of the majority of the Fed members, but it had that negative effect yesterday. Today, ADP released their employment report showing there were 98,000 jobs created in May. Now in June, and that was a little weaker than the 110,000 that the market had planned on. I'm kind of surprised we were less than. Now, it was still in line with a relatively stronger job figure that we've been seeing the last few months. Job growth was seen in all sized businesses, which is great. Small sized businesses once again led the way. Half of the jobs came from education and health services. They added 48,000 jobs to the total and continues to be the main source of job creation. The rest of the jobs were somewhat spread throughout all of the different sectors, but there was no big pickup. There was not a big pickup in leisure and hospitality, which we thought might be the case, specific because of the tourism and travel via the World Cup experience. Wages for workers staying at the same job saw their wages increase by 4.4% year over year. That was flat, unchanged from the previous report. Job switchers saw their pay raise increase by 6.6% from last year. That was up 1/10 from 6.5% in the previous report. Now, some of the information today was the ECB forum in Europe. Specifically, Fed Chair Warsh did not give any comments or indication of where he thinks the benchmark rate is going to be with the Fed. So he did kind of deflect any answers from that. He did make some interesting quotes though. Quote, "We're all in the price stability business. That might not be our only business, but if there was a common thing I heard over the last couple of days, it was open-mindedness on the question of AI, open-mindedness on productivity, But we all looked around and we've seen that prices were too high. End quote. Also, quote, my hope and aspiration is that 9 to 12 months from now, we're going to be using new technologies to understand what's happening in the real economy in a contemporaneous, real-time way that positions us as central bankers to make better decisions, unquote. Very important verbiage there. He is very much trying to move the Fed, and it appears other central bankers, to more real-time data that is much more in line with what's happening real-time versus dated information. Very important there. We also saw today, July 4th is going to be the launch date for Trump accounts. That's a new savings investing vehicle for kids under 18 in the US. Once Trump accounts are set up, eligible children will receive a one-time $1,000 contribution from the Fed government, and families can contribute up to $5,000 a year. The funds are generally inaccessible before age 18 when the account converts to a traditional IRA. Very cool idea with these new savings accounts. However, they're labeled savings account or Trump accounts. I'm not going to get into that, but very cool concept that could change family trees going forward for these young people. We're seeing the market 10-year Treasury up 2 basis points to 4.461. We got hit pretty hard in the afternoon. We got down to about 4.35. So we're up 9 to 12 basis points on 10-year Treasuries. Pressured mortgages up. Dow up another 321. Pretty impressive. So we've said it before, we're on call all weekend to help you get your house under contract, get pre-approved, work with your realtor partners. Give us a call, 616-293-2189. Scott Riley, the Market Update Desk, your original singular market news source for West Michigan.